Welcome back, episode 26.
Ladies, gentlemen,
how's everybody doing?
Phenomenally well.
Good. Keith's in a good mood.
Yeah.
Spry over there.
I had
looking spry.
So since it's episode 26, there really isn't a lot of famous sports players with 26. So I had to go with the Minnesota Viking, Antoine Winfield.
It's not the worst one.
No,
what did we
for
find,
26.
Gangl? What Rod Woodson was the kind of best one
that
we
was
found,
the other
yeah?
more national one.
Which
about
I had
it.
to look that up. That one
Yeah,
I
I don't
didn't
know.
even know.
I don't know that.
26, but yeah, it was a
That's a
little
tough-
bit of a dead zone number.
Yeah.
And I don't think we'll have a problem for a while after this one, but this one was a little bit of struggle.
So you found one though. It's good.
And it's the Vikings. 5-0, right? Got to go with them.
I'll take it.
So last week, Lisa, we talked about EAF, did a little recap, and
Right.
talked about
I
our.
listened to it. I'm
you
your
did.
number one fan
Yeah.
if I'm not on the podcast myself.
So I have to ask you,
Mhm.
what was your favorite part of EAF?
Yeah. So I think generally Jeremy did a very good job in setting up the speakers. So kudos
I did
to
not
you.
pay her to say that.
That is her boss.
Boy.
by the way.
I did.
Not a paid advertising.
Paid programming sponsored by Jeremy Bryan.
No, I think the lineup was just phenomenal, and without just picking one specific speaker, I think it was the mix that really made it great. Like the mix between practice management, where our advisors can use some bits and pieces to bring back to their firm, and also some market relevant stuff, some motivational stuff.
Yep.
So I think it was more the mix of all of them that made it great, rather than just picking one specific one. I mean, we had some big names, which are the stars, but I think overall the mix was phenomenal. And I think what I like even more than the speakers is I think that's the only time of the year when we all have our largest advisors all gathered, concentrated on one spot. And it was my second time already, as you mentioned.
Mhm.
And so it felt a little bit easier this time because people kind of recognized me from last year, or I had some advisory events myself this year. So you can kind of build on relationships already. And we kind of get concentrated feedback if what we do and what we do for them is helpful to them, what we can do better, kind of listen a little bit, what else they would need from us, how we can support them. And I think that's very, very good 2.5 days to get like concentrated feedback and relationship building.
Nice.
I like it.
Our answers weren't that well rounded.
No, not one bit. Like,
Jeez.
that guy had knives. It was cool.
How can you go wrong listening to a seal?
Yeah.
Yeah.
Yeah. That was pretty much our answer.
Navy SEAL, not circus.
clap.
All right. So let's switch gears to our hot button topic. So today I want to talk a little international markets, just because I don't think they get a lot of coverage.
Yeah.
Just because we're US and we're home biased. And so I really want to actually start out, throw you for a curveball here is, so Lisa, you're from Austria, as we all know. Do investors in Austria, do they invest in Austria like we invest in the home bias, or did they primarily invest in US because the US makes up like 50 or 60% of the total world market cap? So do they stay like in Austria, or do they venture out into the US, because that's technically international for them?
Right. So when you live in Austria, it gets international very quick.
Okay.
Because also when you look at Germany, which is like the bigger stock index rather than Austria, I would say it's also strongly home biased. So there's a strong focus on the DAX, which is the German stock index, and also on Europe as a whole. And there is some focus on the US because it performed the last 15 years. It was just the best place to be in. So there's exposure to that as well. But I think as often or as strong as we talk about the US, Austrians and people over there talk about the German stock index, the Austrian stock index, which is pretty small. But anyways, I think there's a strong home bias, yes. Yeah.
Interesting. Well, so I mean, like you said, US has been a hotbed for innovation technology. So I think that's where the primarily investment, especially for US focus, but that's really where the focus has been versus international, because international, Jeremy, correct me if I'm wrong, but international markets are very different than US.
Yeah, compositions very, very different. I mean, just think about technology, and again, this is our home bias kind of, but just think about the technology companies that are leading the world. When does the first non-US company get discussed? I don't know. Where does it start? ASML,
Yeah, I think
TSMC,
ASML,
US
SAP.
used to be SAP, right, back in the day, but they got
Mhm.
lapped.
Yeah. And so, I mean, when you say, technology is kind of running the world, first it was software eating the world, and now AI is probably your next gen of that happening. It's hard. It's hard to say that, that there has been anywhere outside the US has been great for those kinds of things. I mean, they have benefits, they have capabilities, but that has been the hot button. I think that's what they thought about China for a while, and we could certainly get into that. That might be the next wave of companies, your Alibabas of the world. That didn't work out so great, at least at this point right now. But I think that is your story. Is the composition is very different because the makeup of what has been growing and has certainly benefited the U.S.
Yeah, technology is about 30% of the U.S. market, so that's, generally speaking, technology companies that are innovative. To Jeremy's point, I think that's why they've kind of extended their lead over ex-U.S. companies. So,
do you guys think that's largely from regulatory framework, or why is the U.S. the hotbed? Like, because people in technology, it's not like it's U.S. citizens specifically, but like technology and just smart people are around the world. But why did they flock to the U.S. to work at these tech companies versus, starting it up in Europe? Like, is there something different about the U.S.?
I would say it's regulation, but also parts of the U.S. are considered technology hotbeds, right? Just like certain parts of the other world are as well. But, you got Silicon Valley, right? So I think that not even just the American citizens, it drives, international people come to that part of the market. And again, that's a U.S. company then, right? Yep. So I think that's more it. But I do think regulations is, Europe's certainly way more regulated and they're not very friendly to the large technology names that we know, right, Jeremy? We've seen, Jeremy always talks about that's their mantra, basically to, have fine Google, Microsoft, whoever, right? All the big guys, that's kind of like their checkbook when they need some money. It's like, okay, let's go find something we can find Google with, right?
Some
so antitrust, whatever it is. There's different regulate privacy, things like that. So I think that's why U.S. is a little more friendly that way and less regulation.
Okay, I'm gonna throw this one out here at you guys too, because I'm sure you're gonna love it. So we've also seen interest rates in international markets be negative, whether that's Japan, we saw it for a while in Europe, versus the U.S. Yes, U.S. was at ultra low rates, but we weren't negative.
Nope.
So did that cause the carry trade? I had to bring it up because I think it is. I personally think it's a big factor, right? We saw the rush when Japan's central bank decided to make a shift. We saw a
big factor in performance or a big factor in innovation of companies?
Both.
Okay.
Money flowing into.
I'll be interested to hear what
money flowing in to invest in those companies.
Okay.
Because they can borrow at negative rates to then invest in something that's growing a lot quicker.
Okay.
For the potential.
Gotcha.
And that fuels the ability for them to invest in their own technologies.
Okay.
Right?
Okay.
Would you guys disagree?
I'm listening. I'm soaking it in. No, I don't agree. And I'll tell you the very simple reason why is these guys print money, right? These are the best money printers on the planet.
Right now they do.
Yeah, but even, okay, so let's say in the hotbed of innovation, I think that's why you go here, right? Is that eventually, hopefully you make a cool thing that either supersedes Facebook or gets bought by Facebook, right? So I think that's the bigger engine, is that's where the epicenter is of innovation and things. And hey, if I build this, I could become cool and sell this off or build it up myself. I think that's the bigger catalyst than anything that's rates oriented, just my personal opinion. I think that's what drives the overall innovation. That's why, that has stayed in here from that. And then from my side, again, the big companies, especially now that are the big getting bigger, if you will, they don't care where rates are. They really, honestly, I don't think they do. I think, honestly, higher rates probably make sense for them because at least their cash is making something, right?
And it squeezes a smaller guy, too.
Exactly right. So it makes it, makes the moat a little higher, right? So from that side, don't know if I think it was as much. I think there are external forces. I think that could have helped, but I don't think it's the biggest factor.
Sure. I know. I know, Keith.
No, I
agrees with
agree.
Jeremy.
No, I agree with Jeremy. And it's like you're talking negative interest. That was more thing I caught me when we talked about it when it happened, is that these foreign banks were actually, you had to pay someone to take your money instead of getting a return on it, which is like, how does that make any sense? And obviously it didn't last too long, but it lasted in some place
Couple
a years,
right?
Japan
Right?
was
I mean,
a long time.
right? So it's like, that just seems odd to me. So
Yeah.
that's why I kind of scratch my head on that more than your carry trade stuff.
That's seriously like, I think I'll look back on my career and saying negative rates, and when oil went
Negative
inverted
as
for a
well.
while too. Those are probably two of the biggest things where I'll be like, yeah, those were the two dumbest things I've seen in my
Yeah.
career.
Same.
Lisa.
Yeah, I can also.
No one
not-
agrees with me.
No, not.
Hey, you're on an
really.
island, man. Sometimes you got to live on those
Hey,
islands.
I'm just throwing stuff out there, and
He's trying to
as-
promote his shirts. He's
as
got.
I
Yeah.
was,
I
as
mean,
I was thinking about this topic, I was like, I have to throw the carry trade in.
I mean, as Jeremy said, it may be like a little bit of it had influence, but I think overall that was not the main driver. I don't think so. No.
Yeah.
Of money flow into them, I could see that, just simply because, hey, I can borrow cheap, and what am I going to buy? I'm going to buy the cool companies, right?
Yeah.
I get that.
Yeah.
That I'll agree with you on.
Okay.
I'll throw you a little bone there.
Okay. Sweet. So the other thing that I think I find interesting about international is that, at least in my experience, investors don't really want to talk about it, right? And again, my experience is 8 years, right? So I don't have a long time frame. So I want to hear from you guys. In your experience over the years, have you heard a lot of people talking about international markets to invest in? Like, has that been something that someone was like, I need to buy international stocks? Or has it always been the advisor or the portfolio manager, whoever on the investment side, saying we need to add international for diversification?
I think going back for last, like Lisa, that for the last 10, 15 years, that hasn't been the case. But you go prior to that, there was periods when international stocks did perform very well relative to the U.S. So there was not only the clients, but also, advisors and allocators looking at it. And allocators still do it because they're still hanging their hat on, at some point in time, these international markets will work. And that's why we're allocating some. And they will be, right? At some point in time, they will work. It's just a matter of how long it's sustainable or not. So
Yeah.
The old man here can chime in for a second. Japan in the 80s, China in the early 2000s. Everybody wanted a piece of those.
Yeah.
So from that side, there is an element where people do talk about it. It's just been quite a long time since, post China's difficulty. There hasn't been a good story. Maybe Lisa, I'm going to, say something probably offensive here, but I haven't had a European story. I cannot remember. Like, maybe when the euro was first coming out and saying, oh, the consolidated
Early
economy is going to lead the
2000s.
world.
Yeah, that was.
That's the last one I can think of.
But that was also the time when international developed outperformed the US.
Okay.
Yeah.
There you go. So fit together.
There was a time.
There
are
was a
times
time.
where this happens.
It has.
maybe the Euros got to reorg or something, break up in a couple different spots or something. Maybe that would be
Well, because it went great for the UK. Brexit case study and
Yeah.
success there.
Well, I think to that point, there are times that international does outperform US, but they tend to it tends to be glacial in the pace of when US outperforms versus underperforms, right? Like, there'll be a sustained period for a few years where international does do it, and then the US comes roaring back, and there's a sustained period of time, and then all of a sudden the US, the growth kind of tops out for a little while until we get the next technology or whatever it is. And then during that downturn, international begins to kind of pick up the steam a little bit, right? So it does happen. It's just very, I say the word glacial. Just it's slow to transition.
It's extraordinarily
right?
glacial. Glacial is a perfect way to think about it, because post 2009 was a long time ago. The U.S. market has been phenomenal,
Yeah.
right? I know people don't like to hear that. There's been fits and starts. Obviously, we had COVID, we had all the other things. But since 2009, after that crash of, when we didn't think we were going to have an economy the next day, post that, it's been absolutely extraordinary. It's hard for anything to keep up during that time. It's not like European performance has been terrible during that period, right? It's been probably about average, maybe a little under average of long-term trends. But it's just the U.S. has been so good. And I think eventually something changes that course. I have no idea what it would be, but we had a lost decade for 10 years straight here. People were looking for other avenues of approaches then during that period of time. It's just been the U.S. has been so good, and we'll see how long it continues. Maybe it does for a long time, but
it could be like a financial crisis, something you don't think of, like maybe all of a sudden
the punch you don't see coming, right?
It's a debt also is a problem for once, and then I think that would be maybe that's where the U.S. maybe.
What I also find it interesting is we talk about the U.S. and we're just one country, right? With international, we're grouping together
everything else,
20 different countries, and then you talk about emerging markets, which have 50 different countries, right? Like, you're not just getting one sole country's economic growth plus consumer spending. You're getting the goods and the bads of every country.
Yeah.
Right. So I think that I would be interested in a case study on, like, how does an individual country perform? And obviously that's what we try to do in our international portfolios, try to pick which country is going to be the best. But, when you're trying to find,
you went Team Canada for quite a time, weren't you?
Yeah.
You were, you were waving the Canadian flag for a while there. That was great.
Oh, yeah.
Hey, some of it worked quite well.
Yeah. Their banks have been
tough lately.
Yeah. Versus European banks.
Yeah.
But Lisa did find an interesting chart, and I've held some of these names, but I didn't realize how good they have been. But Lisa found the European Magnificent Seven.
Oh, nice.
That has effectively kept up with the US Mag 7.
Nice
So,
pull, Lisa.
What?
That's
no
awesome.
way.
So
Come
what I would
on.
like, I like to call international markets the stock pickers market. Get it?
You
got a
your
wah-wah
button.
there?
Yeah, your button there.
I don't know which one it is.
Yeah.
No.
Don't hit you. Hey, look at that. He nailed it.
So, Lisa,
Yeah.
I want you to kind of give us a description of the companies that make up, because it's not all tech.
Right, correct. So I went with the JP Morgan version of the European Magnificent Seven. There are some different ways out there how you can see it. Sometimes you come across the granolas, and that's not your breakfast cereal. It's just like a mini index, which is composed of 10 companies, which are the largest in Europe. And when we just focus on the European Magnificent Seven, which are consisted of 7 companies, then we see they actually were able to not only keep up with the US Magnificent Seven, which is heavily in tech, they sometimes outperformed. And we saw that earlier this year, they outperformed as well for a short period of time. And I think that's very interesting to me because it's, I think in those 7 names, there's one tech company, and the rest is healthcare, industrials, and consumer discretionary, especially luxury.
I was going to say,
consumer
just looking at the
discretionary.
list.
Yeah,
It's
can
more
you
the-
name some of those companies in the 7?
Give us some of the
some
names.
samples. Other names.
Hermes, for example, Ferrari,
wow.
LVMH, Louis Vuitton.
The ultra luxury.
The luxury.
Not Costco.
Not
Kirkland.
Kirkland and Amazon. I'm already out.
For Ferrari, that surprises me, because especially
Yeah.
with the auto, struggling, they certainly
Ferrari's
have
been
good.
crushing
Well, they
it.
sell what, 12 a year?
Yeah, yes.
And, make 90% profit margin on them.
Yeah.
So that was interesting to me that because it's not tech, and because it's not the US, and because it's more diversified across sectors and countries, it was able to keep up with the Magnificent Seven, which is like the predominant example of success at the moment, right?
Yeah.
It still is.
Because I even thought about it for about a second. I'm like, well, that was stupid. It's like, oh, well, you're just cherry picking. Well, we're cherry picking the Mag 7 too.
Yeah.
That doesn't matter. You can cherry pick all you want from this. What's interesting to me is, there's much more diversification in your list here. Novo, right?
Mhm.
Wegovy and all that stuff that has created just an absolutely new market, right? So I think it's an interesting list. I would have never guessed that they had kept up. It's a very cool list. And the ultra luxury, that tells you maybe that's where European difference actually lies. There's 3 of them.
more
Yeah,
fashion.
and that is despite the China weakness of
Yeah,
luxurious
it's a very good
goods,
point,
and they
yeah.
can still keep
do it.
up. So
Yeah.
Now
that
are
was
those-
interesting, or at least a little idea to think of it,
Mhm.
and not just to have the assumption, just because it works that well over
Right.
the last 10-15 years, it's completely should be out of the question to think about it or look into it.
No,
I think
Sure.
that's-
now with the
that's-
Mag 7, they're roughly our largest 7 companies. 7 are 10, 7 out of 10 or something like that. Now, are the European Mag 7, is that the same case, or are you just literally picking the 7 best performers?
I think there's a difference between the granolas and the actual EU Mag 7. Like, I think one of them is market cap and the other one is performance.
Okay, so it is.
Yeah.
I mean, apples to apples. You're not just picking the 7 best
No,
stocks and
no.
calling them Magnificent 7.
Yeah.
The 7 best.
I mean, like Ferrari is not necessarily the biggest company in Europe.
That's what I was
right?
wondering. That's why
Yeah.
that one surprises me.
Yeah.
Like,
But
Jeremy's
like,
point of 12 cars, I can't believe the market cap's that big.
but like Novo is one of the largest.
Mhm.
ASML is. LVMH is. Hermes is
A little bit smaller, but
Okay.
right?
yeah.
But I think JP Morgan probably put it together trying
Yep.
to find different names that have kept up with the Meg 7,
Mhm.
and that's kind of where they came
Mhm.
up with, and it's a very different looking list
Yeah.
than US.
Yeah.
which
Yeah.
is interesting.
Which again leads you back to composition being the biggest probably driver of performance differential, right? Is that technology is such a large component of ours, and that's worked
Mhm.
very well. This isn't quite as large, and financials makes up a much larger component
Mhm.
of European indices. That could be the biggest source of your differential right
Yeah.
there.
Yeah.
So it is what you're investing in, right? At the
Mhm.
end of the day, if you can find good companies anywhere,
Yeah.
which obviously this includes that. It's just you have to know what you're investing in when you invest in indices. Your
Right.
region may put you in a very different
Yes.
spot from what you're actually investing in.
Yeah. If you're investing in broad Europe, you're going to get some of the Nestle's and some of the bad
Mhm.
performing companies, right? And you just assume that all international is bad because of it.
Yeah,
Right.
and you're going to get a boatload of banks too.
Yeah,
Yeah.
that too. Although they've done okay.
They've done great lately.
Yeah.
Yeah.
All right. One last question about this, and this is me again just throwing stuff out there. So when you think about countries that have done very well as far as performance, specifically China and US,
Mhm.
two countries who are not reliant at all on energy, right? They produce their own, we produce our own. Now they do import a lot, but they also produce a lot.
Yep.
Right. So is there any correlation between countries who are less reliant on outside oil versus countries who are very reliant on outside oil and the potential growth of those countries and the markets?
I think there's probably a cap on companies that are really reliant on just energy, that have to consume a lot of energy but can't produce a lot of energy, right? There's probably a cap on their growth, right? Because you're bound by
It's like a
other
tax.
areas.
Yeah,
Exactly.
it's
It's a tax. That's a very good way to put it. So I think there is a cap on that. You can supersede it over a longer period of time, but yeah, I mean, to a certain extent, natural resources and the ability to develop and use things that are naturally to your own land environment is actually something that they don't talk about a lot, but is a pretty big advantage to economic this is, again, you want to talk glacial, that's super glacial,
yes.
right? But the fact we have two oceans on both sides of us and abundant natural resources is a pretty good backdrop for us to be economically self-sustaining. For somebody else who's, has nothing but mountains in their region to try to be economically viable is tougher. It's possible, but it's tougher. So I think there is a component of, I'm using natural resources, but I think even, if you put that down to oil, if you can drill into the ground, you just have better opportunity, right? So I think there is something to it. I don't know how I can how much I can quantify it.
Can't really quantify.
Yeah, no, I think there's something to it. And I also think from not only the economic side, I think, but security, right? I think if you go back to even to, 70s, 80s, the U.S. wasn't producing that much. So they've certainly accelerated that. And I think it's become better for the security and better for their economy as well.
Yeah.
So I think it's both things.
Well, fracking starting in early 2000s.
Early 2000s,
leading
really,
to-
because now we were always a net importer. Now we can be a net exporter.
Yeah.
So
cool. Just throwing stuff out there on that.
I like it.
I just thought it was interesting. All right.
But maybe a note on that as well, on Europe, when we
Okay.
say in Europe and oil reliance. I think there was a big party the last decade or decades on growth because we grew on cheap Russian oil and we were zero diversified.
Yep.
We got our cheap Russian oil and we never really thought about it on kind of diversifying.
Mhm.
And then there was a big push, especially in Germany, which we see now with their economic problems they have, their big push to renewables and kind of push that way because we could afford it, right? We had cheap oil, we could afford the transition, and then the Ukraine war started. There was no more cheap Russian oil. We had little bit of problems of importing with all the sanction and everything that's going on. Renewables were not there yet to be self-sustaining. And now we see what, for example, to pick out Germany, what problems that caused. An industry heavily on industrials, heavily on energy, and it's just not as cheap anymore. And politics generally are too slow to react to that. We have higher competition from China and all of that accelerating, but it all started with not having the cheap oil that we were used to for so many years.
That's an excellent point. It's an excellent point because you forgot about and the natural gas component of that too, right? Is that we sometimes forget, especially in the U.S., that we are just overflowing in natural gas. Right? Natural gas is not a problem. And so from that side, when those kinds of structures can go away, we're just not used to that, right? We can kind of. So from our shores, it's why can't you just do that? Because it's not as possible. So I that's an excellent point. Thanks for bringing that up.
All right, switching over to nerding out. So I have gotten a few questions on this, and I kind of wanted to touch on it. So we got Fed rate cuts in September, right? 50 basis points, but the longer end of the treasury yields. It's like the 7-year, the 10-year, even some of the shorters are moving up a little bit, but they're going up, which I don't think a lot of people realize that. I think a lot of people were expecting them to come down even further as the Fed cut. All interest rates would come down at a similar pace. Obviously, that's not the case. So I guess what I want to ask is, number one, and we've talked about this a little bit, but do you guys expect more interest rate cuts to come? And we can just say, or we could say, where do you think the interest rates, where the Fed funds rate is going to be by the end of this year and by the end of next year, rather than saying, I expect, 3 cuts throughout the first quarter, whatever. Just where do you think that ending for this year and next year is going to be?
I think we cut, this year maybe. Expectations are changing now, right? Because the jobs market's been a little bit better. So they were expecting 75. Now the market's expecting 50. I could see 50. I could even see 25 if the jobs, if the market's kind of where we're, our call of, 25 basis points in hindsight doesn't look that bad, even though we did 50 right now. They're saying, no, maybe we skip this one and then do 25. So, but if you look out a year, I think that's when you have to look a little longer. I think we're probably going to cut 100, 125. So it gets you to 475 down to 350-ish. Yeah.
I think that's. I gotta take a step back, and when he said, "Now we're gonna go to nerding out," like the last segment wasn't.
Yeah.
But anyway,
super nerding out.
Exactly. We're gonna go even deeper now. I tend to agree where Gangl is. I think 25 would actually be fine this year if we did one more, right? I think based upon especially the recent jobs report. If you're looking at the recent jobs report, you're looking at retail sales data and all that stuff, there's no need to be crazy and aggressive. And so from my side, one more would be fine. But the trajectory over a longer period of time is probably that 3.5-ish range, which again is where I kind of think about equilibrium at that point, right? And then, longer term rates we'll talk about, I know, in a minute, but that's again a function of economic sentiment. We'll see what that looks like. Lisa, what do you think?
I think I generally agree that I think after the job reports, we saw that, okay, it's not as bad. Actually, it's better than expected. So the Fed proved it's really ahead of the curve. And that was the question before the job report. Okay, did they do with the 50 basis points kind of were too late to the game? And that was proved wrong. So there's no need, I think, to overly overdo it with further rate cuts if the job market kind of keeps up.
So the unemployment rate came down. That was the big, and the amount of jobs we added was higher or roughly in line with expectations.
Well, 254,000 was pretty.
That's pretty big.
Yeah, it was a pretty big beat.
Way better than the last couple of months.
Yeah.
So I think it calmed people down about the labor force or the job market being under pressure.
Yeah.
So why do you guys think the 10-year is going up when we're getting rate cuts?
I'll make it real quick. One overreaction to the cuts before, So they brought everybody down, and they probably brought it down too far. Second, again, it's a measure of kind of economic sentiment. And if we think we're going from potential recession to soft landing to no landing at all, right? That's where people's heads, wherever you land in that spectrum, if you're leaning more towards soft and no landing now, your 10-year rate should probably be a little bit higher. So I think that's the thing. I think it was just overreaction at the outset. And then secondarily, now people are saying, well, economic growth might be a little better than we anticipate. That's usually leading towards longer or a little bit higher longer term rates.
Yeah, I agree. And then I think if you look out the next 6 months, we're trying to be in this range kind of where we're at, at 375, 360 to 4.25. We're at a little over 4. So I think we're kind of, Jeremy's right. It was an overreaction. Now we're kind of, I think it's fairly normal right where it's at now. I wouldn't expect a whole lot of movement unless we see different data points on the economy.
Yeah, I agree. I think it's sometimes counterintuitive for people to think of, okay, yields moved before the Fed actually cut rates because that's the expectations. And now that they did, why do we go into the other direction again, right? Yeah. Should it not come down further? So I think that's a little bit counterintuitive. But again, the rates move of expectations rather than the actual cut or the actual action. And I think with, as you said, with the job reports coming in better, economic sentiment is getting better, that was just an overreaction, like you said. And now it's just getting a little bit more normalized again, so to speak.
So I'll answer that real quick on my thoughts. So, I mean, and this is more based on data, but if you look at where we expect the Federal Reserve to cut their rates to, if you think 3.5, let's just take that as an example. Historically speaking, there's 100 to 150 basis points spread between the Fed funds rate and the 10-year Treasury. So say 125. So you should actually be expecting the 10-year to be at 475, right? So I think my expectation is the Fed to be somewhere in that 3 to 3.25 range, somewhere in there. So I would expect the 10-year to be between 4 to 4.5. So that's just based on historical data alone. That should suggest it should be higher. All right. Do I have time for one last question?
Do it quick.
Okay. So what I also find is interesting is there's been a lot heavier correlation between bonds performance and the stock market's performance, meaning when rates come down, stocks go up, bonds go up. Do you think that correlation holds? Because historically that doesn't happen. Do you guys think that right now we're sitting at like a 0.75 correlation out of 1, which
what's
is very
your time
high.
frame on it?
That goes back to 2008. Whereas during that period, you're usually either negative or slightly positive.
Gotcha.
So it's usually not correlated at all.
Yeah. Well, okay. I guess I'm going to answer it in 2 ways. Is that one, over longer periods of time? Yeah, I think the correlation is actually generally positive because 73% of the time the S&P 500 is up, and probably higher percentage of the time on a yearly basis, bond market's up, right? So you have a natural tailwind that's just positively correlated in the beginning. In shorter bursts, no, I don't expect that to hold. I believe that it does have that inverse relationship, is that usually the better part of bond performance is when the stock performance isn't going so hot. So I think it depends on your time frame, right? If you're trying to make a trade, you probably want to bet on more inverse. If you want to say longer term trends, I think they're still positively correlated.
Yeah, nothing to add to that.
All right, cool. Well, we'll wrap it up there just because we're out of time. But subscribe, like, and
hit buttons. Hit buttons, people.
Yeah. And we'll see you next time for episode 27, where Jeremy will pull someone out of a bag that I probably don't know who they are. So
and no carry trade talk.
and no carry trade talk. All right. With that, we'll see you next time.